What if I told you that the money in your wallet isn't really money? That the notes you trust, the coins you spend, and even the numbers in your bank account are, in a very real sense, pure fiction. Yet somehow, despite this illusion, the entire global economy keeps moving. Billions of people keep buying, selling, borrowing, and investing. How did we get here? More importantly, who benefits from a system built on an idea rather than tangible wealth? Today we're diving into the day currency became fiction, yet economies kept running. A story of innovation, deception, and a paradox that governs modern life where imaginary money rules the real world. Setting the stage, a world before modern currency. To understand this story, we need to go far back. Long before dollars, pounds, or yen dominated trade, humans relied on barter systems, trading goods like grain, cattle, or tools. Simple, tangible, and honest. But barter had limits. How do you value a cow against 100 bushels of wheat? How do you store wealth without it spoiling or being stolen? Enter precious metals, gold, silver, copper. They were durable, divisible, and universally valued. Civilizations like Egypt, Mesopotamia, and later Rome minted coins that represented a direct claim to tangible resources. For centuries, the system seemed stable. Money had intrinsic value, but intrinsic value had its limits too. Coins could be hoarded, melted down, or debased by rulers seeking quick revenue. And as trade grew, the physical constraints of metals became obvious. You couldn't easily carry enough gold to pay for a fleet of ships or an army. Then came a breakthrough, or as some would call it, a trap paper money. Origins, paper money, and the first fiction. The first known paper money appeared in 7th century Tang Dynasty China. But it wasn't until the 11th century Song Dynasty that paper currency became widespread. Merchants faced the problem of transporting heavy coins over vast distances, so they used Jawazi promissory notes backed by the government. Here's the twist. The paper itself wasn't valuable. Its worth depended entirely on trust that the government could and would honor the note. This was the first time humans relied on faith in a financial system rather than tangible wealth. Fast forward to 17th century Europe, and we see a similar leap. Banks like Stockholm Banco in Sweden and the Bank of England issued notes far exceeding the gold or silver reserves they held. Fractional reserves were born, a system where banks could lend many times more money than they actually had, creating money out of thin air. And this is where the story starts to get dangerous. For the first time in history, money could exist without existing. The promise of value replaced value itself. The rise from fiction to global trust. By the 20th century, paper money had gone global. The gold standard, introduced in the 19th century, was an attempt to anchor currency in reality. Every note represented a fixed quantity of gold. It worked, until it didn't. World War I was the first major crack. Governments printed money to fund the war, exceeding gold reserves. Post-war hyperinflation in Germany's Weimar Republic made everyday citizens pay billions for a loaf of bread. Money, once real, had become a symbol divorced from reality. Yet somehow, the economy kept running. People continued trading, investing, and borrowing, even when their currency was collapsing. Why? Because society had accepted the fiction as fact. By 1971, the fiction became official. President Nixon ended the Bretton Woods system, severing the dollar's link to gold. From that moment on, virtually all major currencies were fiat money, legal tender with no intrinsic value, backed only by government decree and collective belief. Breaking point. When faith meets friction, fiat money works until it doesn't. Inflation, mismanagement, and political crises expose the fragility of a system built entirely on trust. Consider Zimbabwe in the 2000s. The government printed trillions of Zimbabwean dollars to cover debts and social programs. At its peak, hyperinflation reached 79.6 billion%. A loaf of bread cost more than $1 billion Zimbabwean dollars. Yet despite this chaos, the economy adapted. People switched to foreign currencies, barter, and digital transactions. The fiction was bending but not breaking. Oh, look at Venezuela. Years of fiscal mismanagement and overprinting currency led to catastrophic inflation. Yet daily commerce didn't stop. People continued trading in pesos, dollars, or cryptocurrencies. Economies don't collapse because money is tangible. They collapse when trust evaporates completely. This is the paradox. Economies keep running even when the currency is meaningless, because humans collectively agree to play the game. Fallout. The invisible hand of modern debt. Here's where the story gets darker. Fiat money allowed governments to spend freely, but it also introduced perpetual debt cycles. Central banks can create money at will, which funds wars, bailouts, and social programs. Yet all of this money enters circulation through debt issuance, meaning almost everyone, from citizens to corporations to entire nations, operates in negative balance relative to creation. This is the hidden architecture of modern finance. Every dollar is someone else's debt, and the system's stability depends on continual economic growth. Stop growing, and the illusion falters. The 2008 financial crisis exposed how deeply this fiction is woven. Banks lent trillions of dollars backed by assets they didn't fully own. Mortgages were bundled into derivatives and sold globally. When the underlying value faltered, the world teetered on collapse. Yet economies didn't stop. Governments printed more money, bailed out banks, and the illusion continued.